Okay, so next we would do the same thing for the balance sheet. We are going to reorganize the balance sheet to calculate what's called invested capital, where invested capital is essentially just all of the operating items, all of the operating assets on the balance sheet, minus any operating liabilities on the balance sheet. And so the way to identify them is exactly the same. We're just going to go through, we're going to look at each item, we're going to talk about them, and we're going to talk about why they may not be operating. Now, the first one is a little bit unusual. Again, we'll have some additional class time where we talk about this, but cash and marketable securities are cash and what's called cash equivalents. So marketable securities in the accounting regulations mean they must be able to be converted to cash. I think within like 10 days or something like that. So really quickly, there is some discussion here required about just how much cash is necessary for the business to run. Certainly some amount is necessary. And the question for us is, how much money does UPS actually need in its bank account in order to operate on a day-to-day basis? Presumably, it's probably not 5 billion. And of course, the great sort of swings here, 4 billion in 2011, then almost 8 billion, then down to 5 billion, probably implies that UPS does need some amount of cash, but probably not as much as they're keeping. And so what we would need to do here is separate this into two items, one called operating cash and one called excess cash. And then the operating cash is what we are going to take, and the excess cash is what we're going to ignore. Again, we'll talk about how this split is actually accomplished in a later chapter, so I won't spend any too much time here. But we are going to identify that UPS needs some cash on hand, but probably doesn't need all of this cash. Accounts receivable, that's obviously operating here. This is money that we are owed from selling our product in advance. So this is, part of the normal sales operations of the firm. For UPS, accounts receivable is almost surely stuff like picking up packages for repeat, like big business customers where they have like a monthly contract. They pay for all the shipping that they do at the end of the month, and UPS just picks up, every week or something like that. So clearly, this is going to be operating in nature. Deferred income tax assets is non-operating. This is typically what's called a tax loss carry forward. So this is an asset because it's basically a tax credit that we have. So if we have a loss in a previous year, we have a tax loss, then we can carry that loss forward to offset our taxes in the future. Because we can offset those taxes in the future, it's considered an asset, right? This is essentially like a coupon that we send to the government instead of paying our taxes because we had a loss in a previous year. Almost assuredly, this loss is being carried forward from the 2007-2008 period when during the financial crisis, and UPS lost a lot of money. You can carry a loss forward for like 18 years, so you can carry it forward and offset some of your tax liabilities with it. But again, this is not something that is an asset acquired in operating the business. This is not an asset that we use to operate the business. So we're not going to consider it when we're just looking for operating assets and liabilities here. It doesn't mean that this isn't valuable. We will value non-operating assets separately, just like we valued, say, non-operating income separately, right? So right now what we're trying to do is simply identify just the operating stuff. So other current assets. Now this is, of course, what we looked at when we were when we were looking at the actual filings. Clearly, lots of things have been condensed into other current assets. So we would go and find the table, try and figure out what was in other current assets because we only want the operating current assets. The non-operating current assets would be, we would ignore. Okay. So again, there'd be another footnote here, and we already saw some of this. Other current assets had the financing receivables, it had the income tax receivables. So it would have some things that aren't operating. Financing receivables and income tax receivables aren't operating probably, depending on what they were. So we would ignore those. So the value of this asset is probably less than what's reported here when we're in terms of the value of the operating part of that asset. Net PP&E, this is almost certainly operating asset. These are plant, property, and equipment. So this is all the stuff that UPS owns and uses to operate the business. Now, there is, of course, some possibility here that we don't, or that we have some items, some assets included in net PP&E that aren't used for operating the business. You can imagine the case where, say, UPS had an old headquarters location. They built a new headquarters. They moved into the new headquarters, but they have the old headquarters. And that's still a valuable building. It's still a valuable asset. They might be, say, leasing it out. So they might have some rental income coming from that, right? So potentially they could have here listed it as a net PP&E as some buildings that they own that they don't use anymore. And then over here, they might have some other income coming from rental income on those buildings, right? Potentially that's something that might even get included into revenue, although we would hope they would break something like that out. They almost never break net PP&E out, but certainly we can, there's certainly going to be stuff like property, plant, and equipment here, where they do some breakout, right? So we can see that UPS is listing vehicles, that's operating, aircraft, that's operating, land, buildings, and leasehold improvements, maybe operating. See here they're saying leasehold improvements, so this is improvements on things they're leasing. So certainly they are, again, this is like not fine enough. Buildings isn't fine enough for us to know whether they've got some buildings that they're not using. Plant equipment, technology equipment, equipment under operating leases, construction in progress. So, we could potentially find something in one of these tables that we identify specifically as non-operating. Or it could be potentially be in this footnote here that we've identified something that is non-operating. We'd have to read through all that. But that's what we're looking for. Generally, though, unless we're inside the firm, we're not going to find anything obvious. There's not going to be a smoking gun. So we just consider net PP&E to be operating. Goodwill is, again, the difference between what we pay for a firm if we make an acquisition and what the value of that firm actually is. So this is where that asset is booked. So I paid $50 billion for, or no, that's probably too much for UPS. That's a big firm. I paid, $500 million for a company that I bought that's going to help me with my logistics operations. The value of the company's assets was only worth $480 million. So I booked $20 million as goodwill. This is the difference. I am going to list that goodwill on my balance sheet here. They might have some intangible assets, acquired intangible assets. That's what we're amortizing here, right? And they might have, and of course, UPS has capitalized software intangible assets here. Restricted cash is cash that's reserved for a specific use case. Restricted cash is, you might have it set aside for something like paying off a lawsuit, but you might also just have it set aside for any sort of specific operating purpose. You need cash to do something with. Again, it could be anything, so I don't want to give a specific example here because I didn't read what UPS's restricted cash is for. But we'll typically consider that operating unless we know differently. Investments is not what UPS, again, is not in the business. They obviously have some very valuable stock investments in separate companies. That's where their investment income is coming from. But this isn't part of their normal operations. And so it's not operating asset. Deferred income tax asset, again, these are short-term income tax assets, so they need to expire within a year to be in current assets. The long-term assets are the ones that can continue for up to 18 years, so neither one is going to count as an operating asset here. Post-retirement benefit assets, not going to count. These are additional assets that the company has that they from their retirement plan. They may have more money than they think they need, and they report that as a benefit asset. Again, this is just typically not considered to be an operating asset, and you already heard my soapbox, so there doesn't bear repeating. Other current assets, non-current assets rather, has the same caveat. We're only looking for only operating here, so we would need to go find a table for non-current assets and break open that table. Okay. On the liability side, what we're looking for is any operating liabilities. So loans or liabilities that the firm uses in its day-to-day operations, but we are excluding any loan that is purely just financing. Again, we are going to value the firm's financing and a separate part of the analysis. So here we're just looking for things that the firm uses on a short-term operating, not short-term, on an operating basis. So short-term debt here, this is a financing item. So this is short-term borrowing. Where it's not operating, again, we'll value it separately. Accounts payable, on the other hand, is operating. This is, the reverse of accounts receivable. We're taking supplies, or we're buying things on credit and promising to pay them back in the normal amount of our operations. Accrued wages and withholding, this is operating in nature. Accrued wages is money that we owe our current employees. They have accrued wages that we promised to pay, or we're withholding some kind of payment or some kind of benefit to them. And this is money we owe our employees, so this is operating in nature. Self-insurance reserves. These are kind of interesting. Essentially, a company as large as UPS can't be insured. They're just too big to buy insurance from someone else in general. They have hundreds of planes, thousands, tens of thousands of trucks and cars, thousands of buildings and warehouses, hundreds of thousands of employees. They are just too big to insure, and so they have to self-insure. So they provide their own insurance, and because they self-insure, they have to follow all the rules and regulations that go along with insurance companies. And one of those is you have to have money in reserve in order to pay insurance claims against you. So if a UPS truck driver gets in an accident, they've got to pay the insurance claim on the car that they hit or whatever. The company has to act as its own insurance company, which means it has to have reserves, cash reserves that it holds in case of it needs to pay. Because of sort of the nature of the business that UPS is in, it can't operate without this kind of insurance. We consider it operating in nature. Right, so these are short-term self-insurance reserves. Again, this is current liabilities, so these are short-term. Right. Deferred income tax liabilities. Right, this is money that we owe the government, additional taxes that we owe the government within the year, usually because of some tax dispute where we paid less taxes and then got audited, and the IRS ruled that we owe them additional taxes, and so we pay them additional taxes again. We'll treat taxes separately. Likewise, post-retirement benefit obligations. This is money that we owe to our retirement plan. And again, we consider that to be non-operating in nature, even though this is money that we owe to our old employees. Current liabilities, again, this is just, we're going to have to go find out what's lumped into these other current liabilities and identify just the operating pieces of those. Long-term debt, this is a financing item, not an operating item, so we will value it separately. We got long-term self-insurance reserves, which is operating for the same reason. We got deferred income tax liabilities. Got long-term post-retirement benefit obligations, both of which are non-operating. We've got deferred gains from aircraft sale leaseback. Again, this is an item on FedEx's balance sheet, so I just listed here for comparison purposes. And then our other non-current liabilities, again, we're looking for only the current ones. Only the operating ones, sorry. So long-term operating liabilities here. Then common stock and paid-in capital. This is stock that the company owns in itself, that it is typically using to say, this is sometimes called treasury stock. They're using it typically to pay out or offer to their employees rather, as say employee stock benefit plan or stock grants to their executives. This is not an operating asset. This is not something that they use to operate the business. They simply just own stock here. Retained earnings is already accounted for somewhere else, so this is not an operating. Basically, none of the equity stuff is going to be operating just because of the nature of what it is. So accumulated other comprehensive loss is not operating. Deferred compensation, this is again a FedEx item, so it's not even here. Non-controlling interest is not operating. This is money this is a stake in a firm that we have that we don't have enough of the stake to control, and so we don't report their assets here. Again, this is just not UPS's operations. This is a stake in a separate firm. So all of these here are non-operating. Okay? And then we need to do the same thing that we did for NOPLAT when we're calculating invested capital. Take everything in green here and bring it over to our reorganized balance sheet to help us calculate invested capital. So we can come over to our reorganized balance sheet. We've got our operating current assets, and this one is going to be operating cash. And again, we won't talk about how to determine operating cash until a later chapter, so I'm just going to fill it in for you. Then we go back and we're looking for the other items here that are marked in green. So we've got accounts receivable, and we've got our other current assets, but just our operating other current assets. Then we're looking for our current operating current liabilities. So we go back, we find our current liabilities. We have accounts payable, we have accrued wages and withholdings, and self-insurance reserves. And then we have other current liabilities. Again, just the operating parts of other current liabilities. Oh, no. There we go. Now, invested capital is all operating assets minus all operating liabilities. And so we will try to list all the rest of that stuff right here. The first thing we'll do is what we call operating working capital. So let's do of course, working capital is our operating current liabilities. So I didn't even do this yet. Okay, first let's sum our operating assets. We can sum our liabilities here. Sum our liabilities here. Operating working capital is our current assets minus our current liabilities, or normal working capital. Net working capital is current assets minus current liabilities, so our operating working capital is our operating current assets minus our operating current liabilities. Then what we're looking for is all the rest of our operating assets and less any additional operating liabilities. Okay, so we pop back here, we're looking for the rest of our operating assets. We have net PP&E, we have goodwill, acquired intangibles, we have restricted cash, we have accounts payable, accrued wages, self-insurance reserves. We're going to combine some of all that just to make it easier on ourselves. So we'll pull net PP&E because that is capital equipment, which is pretty important for us. We are going to have an item here called capitalized operating leases. Now, again, this is not, we're going to talk about this later, so I'll leave it out for now. I'm just going to fill this in. Capitalized operating leases is our attempt as the financial analyst to bring the leased equipment that the firm is using for its operations back onto the balance sheet, so that we can treat it, so that we get a better picture of the firm's actual operations, right? And this way it does not allow the firm to decrease invested capital artificially, which increases return on invested capital artificially. Okay. Again, we'll spend more time talking about that. This is still sort of the roadmap. Remember, there's a lot of detail here that we are going to have to talk about in the future. So don't worry about this quite yet. It's just something that we've got to include here. Then we've got other intangibles. We got capitalized software. So we can come back here. Capitalized software. Again, this is UPS considers this a very valuable asset, valuable enough that it specifically lists this software asset on its balance sheet. And then I'm just going to combine all the rest into an item that's other intangibles, intangible assets minus other intangible liabilities. And just to save ourselves some space here. Right, but I can show you what all this is. Right, this is this is just the sort of smaller leftover stuff that we had that we haven't included for. So we come back here and we're looking for the things in green that we haven't accounted for yet. So on the asset side, what we haven't accounted for yet is our other non-current assets and our restricted cash. On the liability side, what we haven't accounted for is our self-insurance reserves and our other non-current liability. There we go. Okay, so then invested capital is all of these assets minus any liabilities. And so we see that our other liabilities outweigh our other assets. So we have some liabilities here, so we can take just the sum of this whole column here. And the sum of this whole column will be all my operating assets minus all my operating liabilities. And this is our invested capital. Now this is excluding goodwill. Remember that goodwill is an asset, and goodwill and acquired intangibles, these are assets that we receive when we purchase another company. So we do two forms of invested capital, and the reason is that we don't want invested capital to be distorted by the firm's purchasing activity, acquisition activity. So the first invested capital, excluding goodwill, will be lower because it will exclude any intangible assets that the firm has received because it made an acquisition of a different firm and paid more for it. The second version of invested capital will be higher, and it'll be higher because we include goodwill and other intangibles. So we will include goodwill here and other intangible assets, these two items, goodwill and other intangibles. Whoops, not a formula anymore. Okay. So this now is the sum here of this goodwill and other acquired intangibles. Now, there's to be consistent with the tables that you'll see in the slides and the book, this is actually goodwill and other acquired intangibles less what's called a tax gross up. And this is something that happens with amortization. There's a tax benefit to amortization. So they are adjusting this item for the tax gross up. This is not, this kind of thing is almost too detailed for the class. So I'm just going to, this is the general idea, then they would have some adjustment for the taxes here. Instead, I'm just going to show you the result, because we haven't talked about taxes yet. But this is the general idea. And then the last item is cumulative amortization and impairments. And again, this is something we haven't talked about yet, so I'm just going to fill in some numbers for you here. And our invested capital, including goodwill, is some of these items. Now notice that this invested capital is going to be higher, and it's going to be higher because we have some intangible assets here that come from purchasing a company.